My name is Maria Smith, and I'm the Chief Impact Officer here at BII. And I'm thrilled to be moderating this panel today. This is about green financing, and green financing has really emerged as a critical lever to accelerate technology adoption. As technology is evolving so quickly, but without the right financial tools, we just won't be able to meet, I think, the potential that we could have. And we're seeing this across blended finance, green bonds, and other catalytic types of capital. So today we've got a really interesting group and mix of people to talk to us about how they are seeing capital flows unlocking this potential and driving real impact. So with me today, I have Lex from Rabobank. I have Marlene from Symbiotics. I have Dominic from Novastar. And I have Ganesh from NMB in Nepal. So I'd like to start by just asking everyone for a few minutes to talk about your institutions and how you're thinking about climate finance or how you're utilizing it within your strategies. Should I start with you?
Yeah, sure. Hi, everyone. My name is Dominic. I'm an investment director at Novastar Ventures. Novastar is a venture capital fund investing at the early growth stage of companies. We have around $290 million under management across 3 funds now. We were set up with the sort of thesis that by backing businesses who are serving the mass market and investing in businesses that are innovating on the delivery of essential products and services, you can scale social and environmental impact naturally as a result of the commercial growth of those companies. We've invested into close to 30 businesses now across those 3 funds. Our first 2 funds explicitly had a social impact mandate. This latest fund that we've raised and closed last year has both a social impact and a climate impact mandate. So we are screening for businesses that deliver social impact for the mass market, for people living under $6 a day in Africa. And we're screening for businesses delivering climate impact. That could be building the climate resilience of climate vulnerable populations, or it could be mitigating greenhouse gas emissions in some way. We find that most of our investments are backing not so much innovative technologies that are born out of Africa, but they're often technologies that are brought from elsewhere and being applied in innovative ways on the continent. Often it's business model innovation that we're investing in. To give you an example, we've invested into an electric bus company in East Africa called Basigo, the first electric bus company in East Africa. Their innovation, electric buses obviously commonplace in many parts of the world. Their innovation in Nairobi was discounting the upfront cost of those electric buses and giving bus operators the chance to pay as you drive. So matching the costs of operation with the revenues that the bus operators were earning, so that it's all of a sudden an investable solution for the bus operators and makes sense on a total cost of ownership basis. To give you another example of how our companies are sort of innovating around making basically climate smart products affordable for the mass market, because that's really our sweet spot, is looking for climate technologies that can be put into the hands of the mass market, a very price-sensitive segment, is businesses that are leveraging the carbon markets to make products more affordable for that segment of the population. We've invested in a business called Systema Bio, which does small biodigester systems for smallholder farmers. So if you have as little as 2 cows, you can load up the waste of your biodigester, and it produces a clean, renewable cooking gas and also a biofertilizer to use on the land. So really compelling circular system, but they leverage the carbon markets to make that product affordable for the smallholder farmers, thereby making the addressable market that much larger. This fund will be around $150 million in size. and will be a sort of Pan-African fund. So historically, we've been East Africa focused initially, then expanded to West Africa. This new fund is focused on Pan-Africa.
Great, thank you so much. Marlene, can I come to you? Do you want to tell us a little bit about Symbiotics and what you're doing, I guess particularly with the green bonds?
Okay, sure, thank you. So my name is Marlene. I'm the Sustainable Bonds Lead at Symbiotics. Symbiotics is an impact investment company which has been active for the last 20 years, investing in financial institutions, mostly microfinance institutions, but also smaller banks, fintechs. And about 5 years ago, we felt that we want to look at these portfolios that we are investing in with a bit of a different lens to shed more light on what actually these underlying assets are. So we started having the sustainable bond framework to issue social bonds, where the assets would be social assets. So for microfinance institutions, that's very obvious, the small underlying loans. We can do this with green assets that were issued by these financial institutions, and also in the mix of sustainability bonds. The way we do this is we have a quite innovative structure, and it is an SPV, which is called MSME loans. So this is actually the bond issuing entity, issuing the green bond with the ICMA, according to the ICMA guidelines. So we can have access to global financial markets and channel this financial or this funding all the way to the end borrower of these mostly microfinance institutions. So on one side, there's the bond structure. On the other side, there's the underlying loan, green loan, social loan, sustainability loan, and we mirror through. We mirror through the bond. We mirror it through all the way to the loan. So I mean, our goal is to give access to finance, to commercial finance, to all the way to the end borrowers with the labeling that we have with the ICMA compliant sustainable bonds. And I'm happy to talk more about how we do the selection, what are the processes, so whatever you want to know more about.
Yeah, I will definitely come back to you, and I think particularly, this tracing from the bond down to the end user, and we all know the challenges that come to that. So I think we'll pick that back up.
Sure.
Great. Lex, can I come to you next and to hear about the specialized lending that Rabo's doing?
Yep, sure. And great to see still so many people here in this Christmas party season. So I hope we're not too long from your Christmas party. Lex Rutte, part of Rabobank. Rabobank, for those who do not know, we're a Dutch bank, a cooperative bank, founded by farmers more than 100 years ago, and therefore a little bit different in the way we operate, I guess. We don't have shareholders, so we're a little bit more free in what we do and what we don't do. And we have a mission called Growing a Better World Together. So we look at financing not only from a pure banking point of view, which we do, but also look a little bit at the impact that we can make. And within specialized lending, we do everything that's non-standard within the bank. So if a client comes to the bank and he needs a normal loan, he goes to the normal loan department. If he needs a securitization or project finance, he goes to that department. If it's a little bit more out of the ordinary, he ends up on our desk, and we try to make something which is a little bit more tailor-made. And for the last couple of years, my focus has been more or less on sustainability. And that started, I guess, with a lot of companies coming to us and saying, look, our CEO has publicly committed to being net zero by 2030. We're on a trajectory, but not the trajectory to get us to net zero at 2030, and we need stuff to change in our supply chain. So we're a bank, as I said, founded by farmers, so we have a real focus on food and ag. And often you see that a lot of the emissions for the retailers, but the big food companies, is at farm level. So they need a change at farm level. But how do you do that when you have a big corporation there and they're telling the farmers or their suppliers, and the suppliers tell the farmers, you need to change, and the farmers just say, look, what's in it for me? What's the business model? How does this work? So that was, I guess, the first wave of requests that came from clients. And a lot of times they didn't move much further because you were talking to the sustainability people, and they were saying, yeah, we need to do this. And then the second conversation was with the sustainability people and the finance people. And then they said, sorry, is this going to cost us money? And the answer was, yes, it's going to cost you money. And then the conversation just stopped. But I think what's interesting now and what's kind of encouraging now is that we see conversations starting up again. But now it's not like we have net zero commitments, but it's very much about our supply chain isn't working anymore. Our farmers are maybe now, but maybe not in the future, are producing the right produce in the quantities and the qualities that we need. So all of a sudden, climate change is becoming a bottom line item. And we've seen examples of that, and I can give a couple of examples later, but where this is now becoming an issue. And we've done a couple of transactions in that space where we finance farmers through funds that we've set up or funds that we finance. And I think what is very interesting to see there, and also in line with what we're trying to say here, is it needs a lot of parties to come together. The retailer on their own can't make this happen. The food companies or the co-ops or the banks or the NGOs or the DFIs on their own can't make it happen. But I think everybody has a role to play in such a transaction. Mm-hmm. And if we make sure that everybody can play to their strength, then I think we can make some really interesting transactions happen. And I think that's one of the reasons I'm here, to see how we can do more of that.
Great. We will pick up on that last point as well, no doubt, in the conversation. Great. Finally, can I come to Ganesh? It'd be great to hear what NMB is doing, particularly in the small business loans. I understand you might have some slides that you want to talk to?
Yeah, I have slides, yeah.
Great.
Hello, and good afternoon, everyone. I'm Ganesh Parazuli, a chartered accountant and currently serving as the Chief of Retail and Small Business Loans at NMB Bank, Nepal. Under my portfolio, the loan segments are like mid-market, and then SMEs and micro SMEs, and then retail and micro SMEs, and lastly microfinance. And the portfolio, I look after around 55% of the total portfolio of the bank. Yes, Nepal has been significantly impacted by the climate change. If we look at the pictures, those are the natural calamities that Nepal has been witnessing since couple of years. Glaciers of Himalayas melting, floods and globs are arising, and vector diseases spreading. Due to unpredictable monsoons, there are a number of floods, and so many the natural calamities have been witnessed by the country. An entire population that is around 30 million have been affected by the impact of natural disasters, and even population of around 100 million population from neighboring states of India like Bihar, UP and West Bengal have been affected by those climate change due to that is occurring in Nepal, because all the rivers from Himalayas are flowing down to the India. So around if we add the population of India that is affected, so around 150 million population have been affected by the climate change and natural calamities. Talking about NMB Bank, it's a joint venture bank with FMO, Dutch Development Bank, and it has around 15% of equity partnership with the bank. And the bank is also a member of GABB, a Global Alliance for Banking on Values, and it got Bank of the Year Asia in 2021, and before that it got Bank of the Year Nepal for 2 consecutive years. And NMB has initiated so many initiatives towards digital transformation and sustainable banking. And the main aim is to have 18% portfolio on hydropower loans by 2035. This is the hydropower portfolio of the bank. Out of total loan portfolio, 12.33% is on hydropower, and it's the market share of that hydropower loan is around 7%, and we have 20 commercial banks, so it's above average. And we have around $200 million on hydropower loans, and around $18 million in renewable energy loans, which are small ticket loans. Okay, bank has taken so many initiatives towards green financing. There are energy bond we have already issued, that is of around $50 million, and a green bond is in pipeline, which is around $60 million. And with regard to electric vehicles, in Nepal, out of total EVs sold in a year, 75% are EVs. And this transformation is, I think, it's in higher side in the world. And similarly, we have green housing products, and we have we have other products like green saving deposits and green fixed deposit, and the deposit mobilized from the public through green saving deposits and green fixed deposits are channelized to green financing. Similarly, for rural greening, we have an agreement with GIZ for de-risking and advising the small customers about the climate change. And similarly, we have partnership with ADB for advising climate risks to the customers. And there are so many other products which are used for green financing. Thank you.
Great. That was very interesting. I'd love to hear more about the credit risk sharing you're doing for the green technologies. Maybe we'll have time to come to that later. Good. Well, we had a call earlier, and we talked about some of the themes that have been coming out of green financing. And maybe I'll start with one that Marlene kind of touched on, which is around sort of traceability and monitoring, and how you really know what is climate finance. How do you track it? How do you ensure you're not greenwashing? And I'm really intrigued about Symbiotics because you are able to follow the chain, which is often incredibly difficult to do. So could you maybe just talk us through your assessment and how your processes around doing that?
Yeah, sure. So the framework, or what I mentioned earlier, the framework, the sustainable bond framework that we have on this MSME, on the special purpose vehicle, is kind of like a green bond framework that usually the institution themselves would set up. But since we're working with a lot of small institutions, they don't have the means to do that. So on this MSME level, we actually do these checks. So we check the 4 pillars, that it's compliant with ICMA, with the ICMA framework, and we also check that the company themselves actually have the means to assess the risks, the social and environmental risks, that they have all the means in place to address this, so that we can actually say that they are an eligible intermediary. So what that entails is, so the first pillar is that we need to make sure that the proceeds can be considered social or green. There is a list of things that can be considered. And then we, of course, have lots of conversations with institutions to kind of dig deeper into what that means. Then we have local analysts who go on due diligence and kind of assess this, if this is actually the case. So this is the identification, and then just making sure how they select, that they have their process in place. So I'd love to see it when we go to an institution and they already have their own products, where we can say, this product we can just make that product eligible, and everything that comes from that product pool, we can take over, and you can use our money to finance this product on your end. And the one that's less interesting for this is how are they, what are they doing with the proceeds? Why, before they disperse, and how they manage that. But then I guess the the most difficult and really the crucial point is how do they measure what they're doing? So how do they measure impact? A lot of investors love to see greenhouse gas emissions numbers, which for some assets it just doesn't make sense to measure that. And then the markets where we work in, it's just sometimes simply not feasible. We don't really have any real numbers, so we work with a lot of proxies. But I think one thing that we say, what we really want to do is we want to be transparent about it. So investors who are buying these notes, they actually know what they're getting into. So we are comfortable with measuring impact based on these proxies, because this is as good as it can get at this point. Is there room for improvement? Lots. Have we seen improvement? Yes, also. We started with just number of loans, numbers, to already assessing the greenhouse gas, so emissions. So that's, I think that's a really good step in the right direction. Now, I guess another very interesting and usually kind of uncomfortable point is what happens if the institution doesn't manage to deploy the funding that we give them? And usually we give them a 12-month period to on-lend, that it doesn't just sit on an account and doesn't work towards anything that we promise it would. So if that's the case, we do ask for prepayments, and we've seen quite a number of prepayments for very, very different reasons. I mean, it can be government, like the government regulation that hasn't come into place. So we, for example, had one institution that had a huge pipeline in solar projects that they wanted to deploy, but the government couldn't set the feed-in tariff, so they didn't know how to price their products. They just couldn't deploy. So we asked them to send back the remaining. We had very ambitious companies who just send us their entire project pipeline, and we said, oh, this is great, all what you're doing, sure, you can use the funding for all that, it makes sense, and half of it didn't materialize. I mean, that's also things that just happen in the market, or that the markets turn and demand just shifts because something else becomes more important. So we've seen all of that. I think usually the prepayment, everybody understood it. And I think it just gives a lot of credibility also to the investors that if they think their funding is working towards something that we promised, a green impact, that it actually does that and isn't just sitting in a bank account, not working towards that goal.
Yeah, and we've actually seen quite a bit of that in our green financing as well, which is, lines are underutilized for a variety of reasons, whether, as you say, it's, government strategic shifts, it's just pipeline development is slower than it can be, or sometimes it's just harder, to find the assets that are within the methodology that we've created. But then what we've tried to do is work with those investees over time so that maybe the second line, right, is right-sized, but also we work with them on whatever the challenges are. Or repurpose in our instance, some of the loan to, let's say, social purposes versus just green, where it can have other sort of impacts, outputs. But, and on proxies, are you seeing, I guess an increase in credible proxies? Do you feel like there is enough sharing of information out there in the ecosystem?
I mean, proxies should not be the end solution, right? Yeah. So it's just kind of one step closer. What we've seen is for one first line that came with TA, that the company then came back to us and they've improved their methodology because that's what they learned through the TA program. So that was something really nice to see. I think the time horizon of like 2 to 3 years is really, really short to say that there's been a huge improvement. But we're seeing small glimpses here and there.
That's good. I mean, that you make a point there too, which this is all very expensive. So I think a question is who pays for this, right? And does it does require, I think, technical assistance and other types of players.
I mean, it's really important that the company themselves, that they believe in it and that they have their champion who really pushes this forward within the company, because I mean, I think you can give them as much as TA as we have out there, but if there's nobody who will take that forward in their own house, then it's just going to die.
I mean, maybe bringing it even up a level, that when you talk about climate finance, I think one of the questions we get is like, why does climate finance differ from any kind of regular finance? And maybe this is a question for Ganesh and for Lex, which is, within your banks, what products do you need to do differently for climate finance? And, Lex, you made the point about each player bringing their own tools. And, maybe we can sort of double click on that, which is, for your institutions, what role do you see playing? And, what products or what differences in product development have you had to see for climate finance versus other types of lending?
Well, I guess you can put that in, or you can divide it in two. I think if we have a huge renewable energy kind of project finance, that's a fairly standardized business. Like everybody knows how it works. The documentation is fairly standard. I think where the challenge is what I just said in the food and ag sector, which has obviously a huge carbon footprint. If you want to reduce the emissions there and do climate, whether you call that climate finance, that remains to be seen. But I think it is climate related in a lot of cases. If you want to make that more sustainable, you need to bring different parties in the chain together. So we work together with, for example, retailers. We work together with the big food companies. We work together with the co-ops. And then finance can play two roles. I think on the one hand, you can say finance is there to finance the investments that otherwise couldn't be financed. So if the local financing community, be it in Africa, be it in South America, or even in Europe, doesn't have the appetite to finance the farmers, being able to provide the financing through a cooperation with different parties can be helpful. The second thing that we see is that finance can also be an incentive. So, for example, we are financing a fund in Brazil that finances soy farmers at cheaper rates than they can normally get, on the basis that they commit to do it on a non-deforestation basis. So there, it's not so much that they don't have access to finance, it's the fact that we can give it to them cheaper. And there you also see that ecosystem at work. So in there you have different parties that contribute to risk. I think very interestingly, this was set up by 3 UK retailers initially who had signed up to the so-called Cerrado Manifesto, where they committed to reduce deforestation in the Cerrado region. Obviously, in a lot of cases like this as well, nothing really happened after 2-3 years. So they then engaged with a fund manager in Brazil to ask him to set up a structure. And what you saw there is that they went in and created this ecosystem where they have one party who is doing credit checks and going out to the farmers and doing the last mile bit, if you like. But they also have a satellite company who is doing all the monitoring of whether or not there actually is deforestation. But I think what was also very interesting, and coming back to what you asked, what are the other risks that you look at? Reputation risk is obviously a big thing. Whenever you do climate finance, if you do it right 9 times and you do it wrong once as a financial institution, you're still going to be crucified, right? Nobody looks at the 9 things that went right. They're only looking at the one thing that went wrong. What was very helpful in this case is that they also had an environmental committee, which had World Wildlife Fund, the Nature Conservancy, UNEP in there. And that gave us a lot of comfort when we started talking to these guys. Okay, listen, you've set this up. They've all come on board. They've signed off on it. That gives us as a financial institution also comfort that, yeah, this is above board. And if something goes wrong, at least I'm not standing on my own here. There's a couple of people with reputations, with good reputations beside me. So I think that's where you see that ecosystem really work. And then this year, MFF, which is also a UK fund for forests, also came in and provided first loss tranches on it. So in that structure, you have a first loss, which was originally the retailers, now also MFF. There's a mezzanine tranche, which is Agri 3, which is a cooperation of Rabobank and United Nations, amongst others. And then we as Rabobank are together with one other fund, we're the senior funder. So that gives us, when you look at a credit risk point of view, that also gives us a buffer. So we can say, okay, we don't know all the farmers that we're financing. It's not a hugely diversified portfolio that you can look at the statistics of it and make sure it works. So I think having that local component of a financing company, or in this case, a company that vets the farmers, combined with some NGOs and some concessional funding,
that makes it a proposition that works.
Ganesh, do you want to ask anything, add anything? Yeah.
Yeah, okay. In case of Nepal, since carbon emission is very less, so I think it's not that relevant. But the main difference between normal financing and climate or green financing is price differentiation. As per the directive issued by central bank, every commercial bank has to have 10% investment or loans on energy and hydropower. So banks have to finance at least 10% of total portfolio. So the only we can advise the customers towards climate financing is price differentiation, and government also provides subsidies for renewable energy loans and for agriculture loans up to 50 million Nepalese rupees.
There's quite a few threads I'd like to pull on regulation, concessional finance, impact-linked incentives. Maybe starting with concessional finance, though, because you mentioned first loss, and obviously we're seeing all sorts of blended finance vehicles and structures related to climate. Maybe a question to everyone, which is, within this sector, where do you think concessional finance is most needed? Where should it be avoided as well? Because I think sometimes it can be overused. I'm not asking that to anyone in particular, but any reflections?
I think it has a place where a commercial bank simply is not able to assess the risk completely. So if we do these kind of structures in the Netherlands, it's not a problem. We have all the credit analysis people that we want. We can do all the analysis ourselves. So then concessional funding isn't really necessary. But I think when you go into areas where either you're not established yourself, or you don't have the capabilities to do the kind of last mile investigation, that's where I think concessional funding can help. And it can help in two ways. It can help for simply being able to do the transaction. So if there was no kind of first loss buffer or at least some sort of credit enhancement, you wouldn't do the transaction. But I think the second thing that you also see is sometimes by having that buffer, it means that you can provide the senior funding at a more attractive rate. So, for example, if I compare, again, what we did in Brazil, but what we also did in a fund in Africa, if you look at what rate you would normally finance the individual farmer, doing it via a fund that has this tranching in it is much cheaper. So we can provide the financing cheaper, which then makes it interesting for either the farmers or at least the beneficiary of the loan, because they'll get a cheaper rate.
And impact-linked incentives. Is anybody using different types of impact incentives within your investments, and is that proving to be effective in achieving your impact objectives?
Yeah, it is. I mean, so one of the examples I can give, which is not related to Africa and to Asia, but is in the Netherlands, and comes back to the argument I made in the beginning. It's public knowledge, I think, so I can probably announce it. It's been announced for a long time. So people may know McCain, potato manufacturer. Mm-hmm. So they came to us and they said, look, what we see in the Netherlands is that through soil erosion and depletion of nutrients, we see that we simply will not have the produce quality and quantity-wise that we need in the coming years. So they put together a whole program for their farmers. And forgive me, I don't know exactly what the qualification, it was something like master, blah, blah, blah. But for argument's sake, say it's bronze, silver, and gold. So they have clearly defined that we want farmers to switch to regenerative agriculture practices. They've defined, I think, top of my head, 10 interventions, and they've also defined levels. So their farmers can sign up to the program and then go through the program and obviously, hopefully get to gold. Mm-hmm. And they pay actually a higher price for the produce if you go through that. So that's a financial incentive clearly to, if you do that, we will give you a higher price. And what we did is we said, okay, listen, we finance 80% of the farmers in the Netherlands. So good chances we know all of them. and we also finance them. So we said, okay, if you are on the program with McCain, then almost automatically you also qualify for a program that we have in the Netherlands where we also want to stimulate people to change their practices and give discounts on the interest rate that they get on the loans from Rabobank. So we said, let's combine the two programs. So rather than doing a separate program, if you are on that particular course with McCain, and if you're a client of Rabobank, we will give you the additional discount. So on the one hand, you get a higher price for your produce. On the other hand, you get lower prices. So I think that's where those incentives can work.
Yep.
Now, that's easier to do in our home market, obviously, where we know everybody. But I think it does show that can really make a difference.
Any other examples?
Okay, in case of Nepal as well, subsidy in agriculture sector is required, as agriculture sector contribute around 60 to 65% on total GDP of the country, and due to the climate change and all other reasons, the agriculture productivity has been significantly reduced in recent years. And that's why government and central bank, mainly central bank, has again a directive that every commercial bank has to have 15% investment on agriculture sector. Government through central bank provides a subsidy to the agriculture loans, small agriculture farmers, having loan size of around loan size less than 50 million Nepalese rupees. So that the private sectors can be attracted to agriculture sector, and there could be some modernization in agriculture sector in the country.
At Novastar, we don't invest with impact incentives. I think the way in which we manage for that is that we screen at the front end to ensure that the social and environmental impact is very core to the business model. So the only way that the business is going to be able to scale is by generating social and environmental impact. So if you look at all the businesses that have failed in our portfolio, and there have been a few, we're a VC, there are failures, the impact has failed because the commercials have failed. So for us, it's really important at the front end to ensure that they're totally intertwined and one leads to the other.
Yeah.
And that's how we manage for kind of impact risk.
Yeah, I mean, the two shouldn't be mutually exclusive, should they? And I think you do have to be wary with impact-linked incentives that you're not paying for impact, right? I mean, so it is something that needs to be weighed very, very carefully. Maybe shifting gears, can we talk about carbon markets for a moment? It's not a moment type of topic, but I mean, Dominic, you mentioned Sistema Bio, but when we think about the carbon markets, I guess related to climate finance, I mean, how important is it? How is important to the total addressable market? How are you guys looking at it?
Well, our target segment is the African mass market, the everyday man and woman, extremely price sensitive, right? So you've got a tool in the carbon markets when used appropriately can discount the price of climate smart technologies and making them affordable to the mass market in a way that they would never otherwise be able to be. To give you an example, we've invested in a business called Cocoa Networks, which is providing clean bioethanol cooking fuel into low-income communities in Nairobi and elsewhere in Kenya, but also Rwanda as well. They earn 70% of their revenues from carbon, but that is passed directly through to the consumer. So the consumer is, they were discussing it earlier on one of the panels, has charcoal just sitting there at the end of every road, extremely cheap, extremely easy to access. How do you displace something as convenient as cheap as charcoal? Well, they've built a supply network which brings the fuel into those low-income communities, but also been able to deliver it at a price point that is cheaper than charcoal. And what happens when you're providing an essential product or service at a price point cheaper than something like charcoal is that you get rapid exponential growth. They went from 0 customers in 2019 to over 1 million households in today. and they're in over 30% of Nairobi's households, for example. So from a venture standpoint, you can really sort of unlock exponential growth by using the carbon markets to bring that price point to an affordable point for the mass market in Africa. And that's something which we're also seeing in the business system of Bio, which is capturing methane emissions in the work that they do. It's a high quality credit they're producing and selling, and their systems would serve sort of middle income farmers without some kind of subsidy that is passed through to the farmer base. But as a result of the carbon, they're able to make their products dramatically more affordable and serve the 600 odd million smallholder farmers in Africa. So it can be used as a very powerful tool. These are high quality carbon credits that can be traced, like cocoa track the entire fuel network, so they can track usage, like each customer has a canister. You can see exactly how much fuel they're using. It's a closed loop system. So that sort of monitoring is essential, and Systema Bio has the same ability to do that with respect to their emission reductions. And that's what sets them apart from others in the market from a carbon credit standpoint. I think we're also seeing a lot of innovation in the carbon removal space in Africa as well, particularly around biochar and harsh rock weathering. There's an abundance of biomass for biochar, very low cost of production. So a lot of innovation in the carbon removal space as well, which I think has a lot of potential for Africa to be a leader in that segment.
It's great to see that sector pipeline developing. So I guess this, looking at the revenue sharing to the end user and the benefit to the smallholder farmer in this instance, is this a critical part of your investment decision making? When is that you factor that in?
Yeah, absolutely. I mean, look, there are still a lot of risks in the carbon markets, and we are very acutely aware of that, and we are therefore mindful of how much of our portfolio, how many of the companies that we're investing in are dependent on those markets. So we kind of manage that risk from a portfolio level, but certainly we sort of give a lot of thought as to whether the business we're investing is leveraging carbon in the right way for impact for one, and the credits are high quality, but that they're also unlocking access to climate smart technologies that would otherwise not be affordable.
Yeah. Right. Any other comments on how carbon markets are integrated into your green financing strategies?
Don't do it.
Yes. Good. Well, great. Should we open it up? I mean, unless you want to give any reflections before I open it up for Q&A? Okay. We'll open it up and just remind for those online that you can put questions, I believe, in the chat, and we'll read them out loud in the room. Yes.
I can shout pretty loud. So I think my question's for. Okay. Hi. I'm also at BII in the Financial Services Group supporting development impact. So I think my question's for Ganesh, but open to anyone. So I'm curious how the process was, the journey within the bank of really building up that institutional knowledge around climate finance, and what that looks like on an ongoing basis as you continue to be kind of a leader in the market.
Actually, can you repeat it? What's the question?
Yes, just about your journey within the bank in becoming really getting the institutional knowledge around climate finance and how to do it well. I think it was also mentioned that it's helpful to have internal champions, and so how you went about building those internal champions and how you go on an ongoing basis on this learning journey about how to deploy climate finance well.
Yeah, thank you. Yeah, we have champions, portfolio champions, and we have segmented portfolio in so many ways, and we have champions for agriculture and for electric vehicles loans, and for housing loans as well, and so on and so. So I think our experience to mass banking is that now the customer or Nepalese people are they have interest on getting climate finance from the banks and instead of other regular loans.
I suppose it also helps that the regulation in Nepal, right, I'm sure has been really helpful in encouraging the banks. Hopefully we'll see more of that across our markets. Yes.
Hi, I have a couple of questions, one for Marlene, you. In what kind of context and what kind of proxy data are you using for impact evaluation? And second one is for you, Lex. Given that you are doing specialized lending, I'm very curious, like what is the most peculiar project that you have funded? That's question number one.
I like that.
The second is, see, as compared to, let's say, traditional lending, what is your interest margin and, let's say, overall return portfolio? You
Also a
may
good
choose to
question.
answer selectively.
So for us, for the impact indicators, our journey has been that we have a lot of discussions with the banks or with the financial institutions of what they can do. And the more pushback I get, the happier I am. Because in the very beginning, in our first few bonds that we've issued, it was lots of proceeds that were made eligible, and then we were saying, "Oh, can you report on this?" And say, "Yes, yes, 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 yes." And then the year later, we received something, and I wasn't sure how to make sense of it. And then the year after, we received something else, and I just couldn't put those two together. So it's really a discussion with the institutions of what they're able to provide. And I think what we've learned is not to overstretch them also, like push a little bit of the comfort zone, but not expect something that they kind of don't feel comfortable with, because that's something that's not going to come. Then we revert to really simple metrics like the number of loans for something, and we define very well what that loan has to look, or what kind of characteristics it has to have. For example, for sustainable agriculture, which is really difficult to evaluate, we are not going to ask them like greenhouse gas emission numbers. They will not be able to get that. I mean, there are ways to get it, but not from this point. So we usually simply go with the number of loan, but we do make a very tight assessment of what do they consider sustainable agriculture. So they need to have their own methodology on how to classify that, because there is a big misconception between agriculture is green per se, which it's not, and we know that. But if the bank or the financial institution has gone through that exercise to classify what they consider green or climate smart, there's these different terms that you can use, or that it can comply with, and it can then be made an eligible asset. So in that case, if we know exactly what it is, number of loans is fine.
Yeah, okay. In case of Nepal, there is no standard procedure to have impact assessment. Government provide a specific procedure to have impact assessment on the climate, carbon emission and impact on the climate.
Interesting. Thanks for giving me some time to think about it. So I guess there's two. One was a success and one is in the fridge. Let's talk about the success first. So at the beginning of this year, or halfway through the year, we entered a fund set up in Africa to finance farmers. And it was one of the most innovative funds that I've seen so far, in a sense that what they did was, it was started by an off-taker of produce who said, look, I want to give my farmers, my suppliers basically, crop financing. But they're not getting the kind of finance that they need. So they went and sat together with a structuring company and with an insurer and set up a program whereby the off-taker would say, okay, I've got a contract here with 100 farmers, and the price is fixed and the amount, the volume is fixed. Can you finance on that basis? And then the fund says, okay, fine, we're going to finance, let's say 75% of that contract. And we're going to do it in a number of equal steps, so 25% at a time. Now, what made it innovative, and this is in South Africa and probably Namibia at this stage, was they also had satellite monitoring, but they also have agronomists. So not only are they looking at the crop, but they're also giving advice saying, okay, listen, you need to either spray a bit more or irrigation or whatever. So it's That's, I think, an interesting component that they do. They also say, if we see that the crop is going to fail, there's no point in giving you more finance because there's not going to be a proceed at the end. So we're not going to over-indebt you. So if we see after 2 payments of 25% that there's not going to be anything there, then we're not going to give you the other 50%. So the other thing that's very interesting is everybody that's in that ecosystem, and there's a couple of input providers there, there's obviously the off-takers there, and this is produce like grain, macadamia, nuts, you like it, things like that. There's also the farmers, obviously, and there's 1 or 2 other parties. They all put money in the fund. So they all have skin in the game. And on that basis, the insurance company was willing to say, okay, I'm willing to give you 85% credit insurance on the farmer portfolio. But I also have 15% sitting in a pot somewhere, together 100%. So I'm going to give you, the financiers of the platform, 100% credit insurance, which obviously makes it a great financing opportunity for us, and it doesn't need really concessional funding then because you've got what you want. The other thing that I thought was very interesting, and I think more of that can be done, is the insurance company also is giving the opportunity to farmers to get some, what I thought was fairly innovative insurance. So they can get a moisture insurance, where basically they monitor what the moisture in the soil is, and if it drops below a certain level, which is effectively a drought, they get a payment. So that covers them also for crop failure, at least through drought. So that's, I think we entered that now, that transaction, and the reason that they wanted us on board as well is because we know all the big food and ag players in the world. This is a platform that can really scale, because if you have an off-taker, if you have, I don't know what, say a brewer who wants to set up a brewery in Africa, they need a malting company who needs farmers to produce barley and then malt. They can come onto this platform and create the financing and therefore guarantee the livelihood. Guarantee is a big word, but help secure the livelihoods of the farmers. So I think that's a very innovative solution that we can scale. The most complex one I did, which didn't happen, or at least is in the fridge, as I said, was actually one with BII, where we have Rabobank.
I think I know it. Yeah.
It's not your fault. No. Let me make that very, very clear. This is not me. I wouldn't be here if it was. Rabobank has an how do I call this? It's not a separate company yet. It's an agroforestry business whereby we select agroforestry projects around the world, South America, Asia, Africa, where we fund the projects. Literally, the farmers get the little seedlings to put in the soil, grow trees, which then helps the soil quality, helps with shade, but also grows a tree that sequesters carbon. And the repayment of those loans to the farmers, they weren't really loans, they were kind of grants, but the carbon credits from that project were going to repay the loans that a number of investors, including Rabobank, BII, IFAT, who was in there, DFC, FMO, they all came together and said, yes, this is a very worthwhile because we're helping the livelihoods of farmers. We're creating carbon credits, we're sequestering carbon, so it's a very worthwhile cause, which I still believe. In the end, it just proved a little bit too difficult to get it done because you can imagine we had an almost 4-dimensional spreadsheet to determine what the financial quality was. The stack of financing started with a junior tranche, then a first loss, then a mezzanine. I think there was another mezzanine and then a senior. So it was fairly complex. And we had colleagues who were saying, well, there's a 79.4% chance we're getting repaid. But effectively, it's binary as well, right? I mean, I've also seen countries that have suddenly said, look, any carbon credit created in my country is our property. If you're just done a project there and you're depending on that carbon credit to get repaid, it doesn't happen. So for now, we were, together with BII, also looking at financing an entity, an SPV, that was going to finance the projects that Acorn selected. in the end, like I said, we've put it on hold because carbon credit markets, things changed a little bit. Hopefully, it's going to start again. But I mean, talking about that kind of stuff where you're getting repaid, you have to start monitoring how the growth of the trees is. How do you get to the farmers? How many farmers will actually plant the seedlings? How many seedlings will grow? What are the carbon credits? What's the price of the carbon credits? And we're going to project that for 10 years. That's a tough one. So that was the most difficult one I think we worked on.
I was on that investment committee, so I do hope it resurrects so that I don't lose the time I had understanding the cap stack and the model.
We had a long conversation about that last night. That's also one. I agree. It's one of the most interesting projects that we've been involved with as well since I've been here. So I have a question, I guess, Dominique, for you, but for anybody who wants to answer. I'm curious how you think about technology and technology transfer. So we think about, I think a lot of times about the carbon tech that's being developed in higher income countries and how we kind of think about transferring that to Africa, to South Asia, and so forth. And a lot of your examples that you gave are companies that have technology, but I'm interested in how much you work with them to think about pushing the technology envelope or introducing them to technologies that can then be implemented in the field.
So you're talking about taking technologies from our markets into other markets.
Yeah. So
other emerging markets, but also global north as
So
well.
any dimension of sort of how technology gets transferred from either high income countries to lower income countries or across low income countries. I'm just interested in kind of how that plays into your investment thesis and how you think about the companies you're investing in.
Yeah, I think increasingly it's becoming more important for us to see a path to at least regional diversification, if not continent diversification. I think places like Nigeria, Kenya, Egypt have all been hit super hard from an FX standpoint in the last 2 to 3 years, which has decimated some of the businesses' sort of revenues in a single year, for example, and those that have been overexposed to a single country have really suffered. So it's not a precondition to our investment at all, but it's certainly, we see a plus if we see a business which is able to scale into multiple markets and we're able to help them do that. So whether that's our roots are in East and West Africa primarily, so particularly when we're looking at a business in South Africa right now, for example, that wants to go to Nigeria. That's great, and we can add a lot of value in helping them do that. I think the sweet spot for us is helping businesses go from Africa to somewhere like India, which is a pretty buoyant market right now. And because that really helps with the perception of Africa risk that we see in our sort of portfolio and in others, is like if you're Africa only, then you get discounted from a valuation standpoint. So the more that you can position yourself as an emerging market growth story, the better from a exit standpoint. So I think that's the sort of, what I guess at scale, what we kind of would aim for from our businesses is trying to go pan-emerging markets.
So I have a question about kind of so Lex, kind of building on your point, it's fun and interesting to hear about all of the many intricate pieces that have to come together into one of these blended finance deals. But that also means there's a lot of people involved, a lot of person hours, a lot of institutions, a lot of costs. So I'm curious for you and for others who might have thoughts on this, what is needed to make these kind of bespoke, innovative financial instruments something that's a little bit more standardized and a little more accessible to kind of expand the pool of opportunities?
Well, one of the things we generally look at is it a scalable initiative? So can we actually scale it? So if I look at the two examples that we discussed here, so the one in Africa, I think, like I said, the reason that we were invited in was, yes, we bring money, but I don't think money per se was the thing lacking. It was, can you bring other big off-takers into the program? So I think if you have something that's already set up and you can plug in, that's the easiest way of doing it. The initiatives that I've seen that are successful generally start with one or two parties really being committed and actually wanting something to happen. So the one in Brazil, for example, we had 3 UK retailers. Tesco, Sainsbury and Waitrose, they just said, look, we need to do something. And they said, here's $11 million, do something, set something up. And then somebody went to work, set up an ecosystem and a structure, and that can expand. In the beginning, what I talked about when we had people coming in saying, look, we have an issue with scope 3, can you please help us? The first thing we always ask is, okay, fine, so you want the farmer to change, what's the business model? What's in it for the farmer? And if they can't answer that question, and in the beginning that was quite often the answer, well, we don't know, we just want them to change. Yeah, but tell them, what do they need to change? So the McCain example is great because they really defined, this is what we want you to do. So that brings clarity, I think, to the farmer. This is what we want from you. And then the second thing is, does the business model work? So if it's just investment on the farmer side and there's nothing coming, it doesn't work. A farmer is an entrepreneur, right? If somebody asks you, well, we want you to do more, but we're not going to pay you more, it doesn't really work. So I think that's the starting point. And then getting people together, having an integrator, be it a bank like ours or a fund manager who sets something up, to really then take the parties along and say, this is the way you do it. That's the way it works. We set up a fund for farmers in Ireland a long time ago, 7, 8 years ago. And there we started with doing it for one co-op because they had a very specific problem where they wanted their farmers to invest and the farmers weren't investing because milk prices were very low, volatility in the market, so they didn't. We set it up for one. About 6 to 12 months later, the other 10 co-ops, dairy co-ops in Ireland, all came knocking on the door saying, we want the same. So we set up a second fund for all the other ones. So it starts with 2, 3 parties with knowledge and really being committed to do something and knowing what needs to happen to start it. And then you want something that's scalable. You want something like a fund or something like that, that is plug and play for other people to come on board and say, look, it's there. It's vetted, and like I said, for example, in Brazil, having the NGOs on board makes it much, much easier for other institutions to come on board. So you have to look at what needs to be there in order to scale it. But the example that I gave about the discussions in about the agroforestry, yeah, we had about 20 people in the room.
Well, and we weren't even designing it, and I think in our investment committee it was the most attended. We had something like 30 people in the room, and I did look around and say, this is a very small check for us. And there are, if you start doing the maths on dollar per person in this room, it's like, so I think your point is spot on. And one of the lessons we've had in this area is, one, not to layer complex, like too many layers of complexity is not good, right? I mean, we're trying to solve hard things, but when you start layering, a business model that's complex with a sector that is nascent, with a capital structure that's very complex, the layers of complexity is, I think, when it's hard to get things right. So stick to the problem you're trying to solve, and also to stick to your core competency, or at least make sure you have the people in the room that are within their core competency. And on blended finance, we've been seeing all sorts of innovative, weird, and wonderful structures come through, and we have felt like there hasn't been very good guidelines, especially from fund manager perspective, on like what good looks like. So we actually wrote a paper last year, which is on our website, that starts to just give some leading, sort of principles in terms of what to look out for when you're creating these types of funds, to try to keep it simple and consistent, because we shouldn't be reinventing the wheel every time we create one of these funds. We also should not be creating capital structures that are essentially just designed to meet the different interests and parameters of the DFIs that are in them. And so if that's of interest, you should check it out. Yes. we can take one more question.
Hi, thanks. I was just curious to think a little bit more about how the portfolios vary across the different types of green financing institutions. So I sort of have like a one-dimensional perspective of what a VC funds, and so I think of it as like pre-scale, very immature types of companies, whereas like maybe some of these other financing is looking at kind of already established businesses. And so I'm just curious if you guys think about that, if you would like, be like, it's not appropriate for us to be the funder here. You need to go see a VC. And now I met one, and his name's Dominic. I don't know.
You're exactly right with respect to the profile of a VC portfolio. Typically, it's like pre-profitability. Often we're investing for growth and exponential growth. We're not trying to invest in SMEs. We're trying to invest in businesses that can grow and scale to be $100 million revenue businesses and plus above. That means there's a certain type of profile of business that's interesting to us, and it's often the scalability of the business, which is a necessity. And we find that often there are gaps in the capital ladder. We try and fill one of those gaps. Our sweet spot, I would say, around the Series A, Series B spot. But certainly when the biggest ask of us as an investor, we take board seats on the companies that we invest in. The biggest ask is always capital raising support. And that's not just equity capital, that's also debt capital as well. And a lot of our businesses are at an early stage. And I think the thing that they find most difficult is finding the right sorts of debt capital that is able to write checks that are appropriate for the size of business at which they are. It feels like it's a lot. Once you get to a certain point and profitability is in sight, you can raise debt capital, but like in the earlier stage, and it touches on maybe some of the concessional vehicles that are out there for certain sectors, are proving really valuable because that's some of the biggest challenges in our own portfolio.
So we're clearly coming after you. So for private debt, ideally, the break-even point, we require a certain governance maturity also of the company. They should have processes in place to identify risk, not just credit risk, but also the social and environmental angle. And then we are happy to come rather early and then grow with the company and give them just growth capital over time or give them several lines. But not the very first ones.
I suppose we're sitting in order of graduation
Yeah.
here, actually. This is probably exactly not intentional, but...
Yeah. No, I think on the climate financing and the type of stuff that we look at, obviously the farmers are an established entity. We know how they work. We know whether it's a viable business to start off with, and they're existing farmers. And then we also work with clients, what we call the wholesale clients, the larger clients. And together we try and do something. So I think we're doing new things, but with existing business models, if you like. So for us, the innovation is more in how can we finance the transition that needs to happen, but in existing businesses.
Okay, we have a new product like digital loans to small farmers. The ticket size is around it's below 500,000 Nepalese rupees. That's the new product we are working on. And I think for the investors abroad, I think a green bond would be the good product.
Right. Well, I think we're at time, but thank you so much to our panelists for sharing. Thank you so much to the audience for engaging with all of those questions. And I'm going to pass it on to Chris for the final comments.
I'm going to change the mic over here to get this. So I just want to say thank you all for, as Lex said, the Christmas season parties and so forth, and you're still here. Thank you for the active participation during the day for all the panelists. It was if you got half as much out of it as I did, then you had a great day. It was really sort of an engaging set of conversations and so forth. mostly I'm here to thank Mamuna, who helped, who was the organizer from the BII side. So round of applause for. And then from the CEPR side, Mandy, who's not here, but Clara and Vito, who are here, helped organize things on that side. And then finally, you know, although sort of in some senses I was copied on a lot of emails, Patty did all the work of really organizing all this. So also he deserves the credit for getting us all together. So thank you all. This is the second one of these we've done on a different topic. Last year was on finance, and this year on technology, and we hope to continue doing these in future years on various topics. So thanks a lot for coming, and hope to see you again.